All right, everyone, welcome. Today, we're going to do a deep dive into a concept that is absolutely fundamental to corporate finance and accounting: the long term note payable. Now, I get it. That phrase doesn't exactly scream excitement, does it? But I promise you, understanding this tool is critical. This isn't just about plugging numbers into a spreadsheet. It's about understanding the engine that powers a company's biggest, boldest moves, the kinds of decisions that can define an entire industry. So let's jump right in.
Okay, let's make this real. I want you to imagine you're on the senior leadership team of a tech company that's just exploding. Your forecasts show that in about 18 months, you're not going to be able to produce enough to meet demand. So the board gives the green light to build a huge, new, state-of-the-art factory. The price tag? Let's call it $200 million. Now, that's not money you just have lying around in your checking account. So the big question lands on your desk. Where exactly does the money for a massive, long-term project like this come from? Well, the answer comes down to one of the core principles of smart finance. You have to match your financing to the life of the asset. Think about it. Taking out a short-term loan that's due in 6 months would be a complete disaster, right? You'd have to pay all that money back before the factory even produces a single product. No, what you need is a financial tool that understands the long game, a formal agreement that gives you the cash you need today, but with a repayment plan that stretches out for years, giving that new factory plenty of time to start making money and, essentially, pay for itself. And that brings us to the official name for this tool, a long-term note payable. Let's just break that down. Note payable is simple. It's a written promise, a liability, an IOU from the company. But the key words here are long-term. In the world of accounting, that has a very specific meaning. The due date for the final payment is more than 1 year away from the date on the balance sheet. And trust me, that 1-year mark isn't some random line in the sand. It's a critical piece of information for anyone trying to understand what's really going on inside a company. You know, in finance and accounting, you can't really understand one thing without understanding what it's not. And to really appreciate the strategic power of a long-term note, we have to look at its counterpart, the short-term note. The difference between these two isn't just a boring accounting rule. It's like a window into a company's soul. It tells you about its immediate health, can it pay its bills next month, and its long-term dreams. Getting this distinction right is absolutely fundamental. So this slide lays it out perfectly. On the left, you've got short-term notes. These are due within a year. Think of them as tactical tools. They're for managing the day-to-day grind, buying inventory you plan to sell quickly, or making payroll when cash is a little tight. It's all about surviving and thriving in the short run. But then over on the right, you have the long-term notes. These are due after a year, and their purpose is completely different. It's strategic. This is the money you use to buy those huge income-producing assets, that new factory, a major acquisition, or a game-changing R&D project. And this quote right here, it nails why we care so much about that 1-year dividing line. Whether you're an investor thinking about buying a stock, a banker deciding whether to approve a loan, or a manager inside the company trying to plan for the future, you have to know when the company's bills are due. I mean, imagine a company with a ton of debt that's all due in the next 6 months. That's a high-wire act. They're under immense pressure. Now, picture another company with the exact same amount of total debt, but it's all structured over 10 years. That company has breathing room. It has time to execute its plan. As an analyst, you see those two companies as having completely different levels of risk. Okay, so we've established that the time distinction is critical, but that's not the whole story. There's more to a long-term note than just its due date. So let's dissect this thing. Let's look at its anatomy to really see how it works. All right, so here are the core pieces. First, the due date, which we've hammered home. It's more than a year. Next up is the principal. That's just the face value of the note, the actual amount of money that was borrowed. And as a rule, we're talking about much, much larger amounts of money here than with short-term notes. Third, and this is so important, is its purpose. A long-term note isn't a reaction to a problem. It's a proactive move, a deliberate piece of the company's big-picture financing strategy. And finally, its nature. This is a formal, legally binding contract. There's no wiggle room. Defaulting on it has very serious consequences. Let's just focus on this idea of larger amounts for a second, because it connects directly to a company's biggest decisions. A short-term note might be for $50,000 to buy some raw materials. That's an operational choice. A long-term note, on the other hand, could be for $500 million to build a new global headquarters. That's a strategic, company-defining decision. So when you see a huge long-term note on a company's balance sheet, it's basically a giant billboard telling the world, hey, we're not just managing the day-to-day, we are making massive long-term bets on our own future. And this brings us to what I believe is the most important takeaway for all of you today. It is a huge mistake to look at a long-term note payable on a balance sheet
and just see debt. That's a rookie error. You have to see it for what it really is, a strategic tool. It's an instrument that visionary leaders use to fund the big moves, the kind of investments that will shape where the company is 5, 10, even 20 years from now. This slide gives you the playbook for how this works in the real world. Let's walk through it. Put on your CFO hat again. Step 1. Identify an opportunity. Your team finds a smaller company with some incredible AI technology that could revolutionize your products. Step 2. Figure out the cost. You run the numbers and realize you need $250 million to buy them. Step 3. Get the money. You work with bankers to issue a 10-year note to raise that cash. Step 4. Make the move. You get the funds, and you complete the acquisition. And now for the final, most important step, Step 5. Pay it back. Over the next 10 years, that new AI technology drives huge sales growth and profits. And those new profits are what you use to easily make your interest payments and pay back the principal when it's due. That is financing strategy in action. So this is the crucial mental shift I want you to make. You're not just borrowing money. You're using a powerful concept called financial leverage. Leverage is simply using borrowed money to buy assets. The whole game is to make sure the return you get from those assets is way higher than the interest you're paying on the debt. So in our example, if that new AI company brings you a 15% return every year, but the interest on your note is only 5%, well, you're using other people's money to create massive value for your shareholders. It's a calculated, strategic investment in the future. Okay, let's bring this all home. Why does this matter to you? As the next generation of managers, investors, and entrepreneurs, why did we just spend all this time on a single line item on a balance sheet? It's simple. Because if you can't read the story the numbers are telling you, you can't make smart decisions. Period. And that leads us to one of the biggest and most common mistakes I see from students who are just starting out in financial analysis. They'll look at a company's total debt, see a big number, and immediately say, whoa, that's too much debt, this company is risky. But that's a massive oversimplification. A true analyst knows the question isn't just how much debt, it's what kind of debt is it and what did they use it for? Look at this chart. A company whose debt is mostly short-term, that could be a huge red flag. It might mean they're struggling just to pay their bills and to keep the lights on. But a company with a high amount of long-term debt, that tells a completely different story. It could be the sign of a confident, ambitious company that's investing heavily in its own growth. You see the difference? The composition of the debt tells you so much more than the total amount. So when you truly master this concept, you gain a powerful set of X-ray goggles for analyzing a business. You can look at a balance sheet and literally see a company's ambition. You can tell the difference between a company that's just trying to survive and one that's building an empire. You can judge whether their growth plans are realistic. And ultimately, you can make smarter, more sophisticated decisions no matter what your role is. If you walk out of here today remembering just one thing, let it be this. When you see long-term notes payable on a financial statement, I want you to train your brain not to just see a number. I want you to see the new factory, see the groundbreaking research, see the global expansion. I want you to see the vision. And that brings me to a challenge for you. I want you to go out and pick a big public company you're interested in. Apple, Tesla, Netflix, whoever. Go to their investor relations website and pull up their latest annual report. That's the 10K. Find their balance sheet, look at the liabilities, and find their long-term debt. Then try to connect that number to what you've read about them in the news. Ask yourself, what are the big long-term bets this company is making? And how are these financial tools, these long-term notes, helping them turn that vision into reality? Because that is when accounting stops being about bookkeeping and starts being about strategy.